Disclaimer: this material is provided by company for informational purposes only and is not intended to be and should not be considered legal advice. This communication does not establish any attorney-client relationships between me, company, or KWRI and any market center or associate. You must obtain legal advice from your own counsel on any particular matter that concerns you. And welcome back, everyone, to Everything Real Estate Podcast. Today, we're going to be talking about inflation, disinflation, hyperinflation, and every other inflation there is out there. So I'm going to start off by giving you an explanation of what each one is and how it works. Then we'll get into how to combat it and the benefits that comes along with inflation. Great, so let's start. What is inflation? Inflation is a rise in prices, which can be translated as the decline of purchasing power. The rise in prices, which is often expressed as a percentage, meaning that a unit of currency effectively buys less than it did in prior periods. Inflation is the rate at which prices for goods and services rise. It is sometimes classified into three types: demand pull inflation, cost push inflation, and built-in inflation. The most commonly used inflation index is the Consumer Price Index. Inflation can be viewed positively or negatively depending on the individual's viewpoint and rate of change. Those with tangible assets like properties or stock commodities may like to see inflation, as that raises the value of their assets. To understand inflation, while it is easy to measure the price changes of individual products, our needs extend beyond just one or two products. Inflation aims to measure the overall impact of price changes for a diversified set of products and services. This loss of purchasing power impacts the cost of living for the common public, which ultimately leads to a deceleration in economic growth. Inflation is measured in a variety of ways depending upon the types of goods and services. It is the opposite of deflation, which indicates a general decline in prices when the inflation rate falls below 0%. Keep in mind that deflation shouldn't be confused with disinflation, which is a related term referring to a slowing down in the positive rate of inflation. So what causes inflation? What causes inflation is an increase in the supply of money. An increase in the supply of money is the root of inflation, though this can play out through different mechanisms in the economy. The money supply can be increased by monetary authority, by printing and giving away more money to citizens, legally devaluing the legal tender currency, loaning new money into existence as reserve account credit through the banking system by purchasing government bonds from banks on the secondary market, which is the most common method. In all these cases, the money ends up losing its purchasing power. The mechanisms of how this drives inflation can be classified into three types: demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation occurs when an increase in the supply of money and credit stimulates the overall demand for goods and services to increase more rapidly than the economy's production capacity. This increases demand and leads to price rises. When people have more money, it leads to positive consumer sentiment. This in turn leads to higher spending, which pulls prices higher. It creates a demand-supply gap with higher demand and less flexible supply, which results in higher prices, which we've seen in the real estate market. Cost push inflation is the result of the increase in prices working through the production process inputs. When additions to the supply of money and credits are channeled into a commodity or other asset markets, costs for all kinds of intermediate goods rise. This is especially evident when there's a negative economic shock to the supply of key commodities. These developments lead to higher costs for the finished products or services and work their way into rising consumer prices. For instance, when the money supply is expanded, it creates a speculative boom in oil prices. This means that the cost of energy can rise and contribute to rising consumer prices, which is reflected in various measures of inflation. Built-in inflation is related to adaptive expectations that people expect current inflation rates to continue in the future. And as the prices of goods and services rise, workers may demand an increase in wages to maintain their standard living. And that contributes to higher costs of said goods and services. So individuals with tangible assets may like to see some inflation, as that rises the price of their assets, which they can sell at a higher rate, which leads to speculations. An optimal level of inflation is spending to a certain extent instead of saving. If the purchasing power of money falls over time, it may increase spending, which may boost economic activities in the country. And a balanced approach is thought to keep the inflation value in an optimal and desirable range. Inflation is controlled by implementing measures through monetary policies, which refers to actions of central banks or other committees. The Fed's monetary policy goals include moderate long-term interest rates, price stability, and maximum employment. Each of these goals is intended to promote a stable financial environment. The Federal Reserve clearly communicates long-term inflation goals in order to keep a steady long-term rate of inflation, which is thought to be beneficial to the economy. Price stability allows you to plan for the future since you know what to expect. The Fed believes this will promote maximum employment. Maximum employment does not mean zero unemployment, as at any given time there is a certain level of volatility as people vacate and start new jobs. Now, why is inflation so high? In 2022, inflation rates in the US and around the world rose to their highest levels since the early 1980s. While there is no single reason for the rapid rise, a series of events worked together to boost inflation to such high levels. The COVID-19 pandemic in early 2020 led to lockdowns and other restrictive measures that greatly disrupted global supply chains, and at the same time, governments were issuing stimulus checks and increasing unemployment benefits to help blunt the financial impact of these measures. And as we overcame the pandemic, the economy rapidly bounced back. Demand quickly outpaced supply, which still struggled to get back to pre-COVID levels. And now we have mortgage rates that have risen along with inflation. And higher rates coupled with pandemic-fueled price increases have caused affordability issues in some of the high-flying markets around the country. And the amazing part about real estate is that it offers advantages during these inflationary periods. And this recent run-up is no exception, because an inflationary environment creates opportunities, which is an attractive option because rents are bound to rise along with inflation. And as rates rise, demand for rental homes is likely to increase as well. With housing prices rising with inflation, owners will see appreciation. And with the country with 3.8 million units short of demand, according to Freddie Mac, upward pressure on prices means that long-time owners have already seen the value of their assets increase more quickly than at any time in recent memory. And mortgage payments don't change over time, but inflation means the money paid back in the future is worth less, because as equity grows, fixed rate payments stay the same, and inflation generally has little impact on mortgage rates. Now let's quickly go over disinflation and deflation. Disinflation is used to describe the slowing of price inflation. In other words, it is a decrease in the rate of inflation. And deflation is used to describe a negative inflation rate, which is a decrease in prices of goods and services in the economy. So what causes disinflation? And it is important to note that inflation is caused by an increase in the supply of money in the economy. Therefore, a slowdown in the economy's money supply is an underlying cause of disinflation. So to determine whether the economy is experiencing inflation, disinflation, or deflation, we first must determine the inflation over each year by determining the annual change in CPI between years. Doing so gives us the inflation rate for each time period. Now let's continue with hyperinflation. So what is hyperinflation? Hyperinflation is a term to describe rapid, excessive, and out of control price increase, typically measuring more than 50% per month. Although hyperinflation is a rare event, it has occurred many times throughout history in other countries, which is an extreme case of inflation, not just a high inflation rate. It is critical to remember that hyperinflation doesn't happen very often. However, there are some actions you can take to reduce the effect of normal or high inflation, which real estate can reduce the adverse effects of inflation because it tends to increase in value during these times. And when structured correctly, you can see the significant benefits it has. And finally, stagflation. Stagflation is characterized by slow growth and a high unemployment rate accompanied by inflation, which makes stagflation difficult to combat. There is no real consensus among economists about the causes of stagflation. They put forth several arguments to explain how it occurs, even though it was once considered impossible. Some theories that cause supply shock would be oil prices, poor economic policies, and the loss of the gold standard. Though there is no definite cure for stagflation, the thing is that productivity has to be increased to the point where it will lead to higher growth without additional inflation. The bottom line is, if you would have bought a house for $250,000 in 1995, in 2019 it would be worth $419,000 or more. Keep in mind, this does not consider any appreciation that the home has acquired. It solely takes into account the spending power and value of the dollar that has been changed due to inflation. So the question becomes, how can I combat and profit from inflation? Let's evaluate real estate as a tool to combat inflation and produce cash flow. Real estate is often seen as an inflation hedge. An inflation hedge are typically assets that expect to increase or at least maintain in value over a period of time. This plays into three aspects that make real estate a great tool to combat inflation: appreciating value, increasing income, and depreciating debt. One of the most beneficial aspects of real estate is appreciation. On average, properties value appreciate between 3% and 5% annually. And in some markets, appreciation is anywhere between 6 and 10%. To illustrate, if you bought a house for $100,000, assuming an annual appreciation of 6%, you'd have a property valued at $179,000 in just 10 years. Even at a more conservative 4%, the property would be valued at $148,000. Comparing it to inflation from 2009 to 2019, there was roughly a 19% rate of inflation, meaning your $100,000 purchase would cost you $119,000 to buy it again in 10 years. As you can see, you've not only kept up with inflation through real estate, but you've added value and gained appreciation. The awesome aspect of real estate is the cash flow. Smart investments in rental properties will not only cover your monthly expenses, including your principal loan balance, interest, taxes, and insurance, but will also generate $100 to $400 per month in cash flow. Even better, rental properties, if managed wisely, can garner rent increases annually, generating more cash flow than your original investment. If you have a property that generates $1,000 in rent per month, if you gave an increase of only $20 per year, in 10 years you'd receive an additional $200 per month in cash flow. And just as your real estate asset is appreciating in value, your debt owed on the property is actually depreciating in value with the rate of inflation. To simplify, your $750 mortgage payment in 1 year is worth $750. However, in 10 years with inflation, that debt is going to be worth far less. For consistency, we will use the 2009-2019 inflation rate. If your payment is worth $750 in 2009, by 2019 it will only be worth about $640 due to inflation. When you use leverage or financing to invest in real estate, you get to take advantages of depreciating debt. Of course, your monthly payment is the same. You will still be making that $750 payment per month year after year, but the value of that payment will be less as time goes. Though inflation is inevitable, it's either a high rate, a steady rate, or somewhere in between. Even in our down economy between 2009 and 2012, the inflation rate still averaged around 2%. One of the best ways to combat inflation and even win the game against it is through inflation hedge investments like real estate properties. Now, to wrap this up, given this information, you can either use it or disregard it. My recommendation to you would be to use it. Anyone can be successful in real estate. You just have to lose that fear. On the next episode, we'll go over how to turn your personal residence into a tax-free rental. So stay tuned. So, if you found any value in this information, make sure you subscribe and visit the Everything Real Estate website. You'll find more information and tons of videos on how we can contribute to your success. And thank you for making this a part of your day.